Welcome to the Forsyth Magazines podcast. I'm Brooke Eagle, your host, bringing you the stories of the people shaping our community. From business owners to local leaders, we'll explore their journeys, passions, and lessons learned. Let's dive in. Hey guys, we are back with another Forsyth Mags podcast episode. And today I have John and Todd with Woodard and Company Asset Management Group. Hey guys, how are you?
Good. How are you?
Great.
Good. Thanks for coming to chat with us today. So I want to start things off by having each of you introduce yourselves to our listeners. So We'll start with Todd.
Sure. Thank you. Todd Senter. I been with Woodard and Company now for it'll be 22 years this August.
Wow.
Yes. And so it's been a while. But one of the advisors there and advisor representative, and we're a registered investment advisor. So work with the investment committee with John and John's dad, Matt Blades, Steve Hungerford, and John's mom, Joan, we all work together as a team. So
Awesome.
Been there for 22 years, worked in the insurance industry about 8 years before that, graduated from Appalachian and in 96 with a business degree, and before that, proud graduate of West Forsyth.
Oh, me too.
So, all right, good deal.
All right, John.
And I'm John Woodard III. I've been with the firm for about 2 years now. I graduated from Virginia Tech, summa cum laude with a master's degree in finance, minor in economics. I worked with Fidelity for about a few months before coming to join Woodard and Company. And since then, it's been great. I'm working to get my CFP, Certified Financial Planner. It's one of the few designations I'm getting to do the journey on now. But
Awesome.
It's been great. I've been enjoying just working with the team, and it's very wonderful to work with such knowledgeable individuals, also people with just a lot of experience. Combined, all our advisors have about 100 years of experience in the industry. So it's just great to be able to have that ability to listen and learn from all of them, and also be able to say my 2 cents as well. It's not maybe as worth as much as one's like my father, who's been in the business for 47 years, but it's a new perspective.
Yeah. What is it like working in the family business? Did you always know you wanted to do that?
No, not always. I think growing up, they never directed me one way or another, but I just always, in the house, we'd be watching the news and talking about stocks. And I just eventually in college, when I found my way and actually realized I had to get a grip on life and start making something of myself, I started enjoying just reading the news, and I kind of found myself that way. And my father and I, we have a farm out in Moxville, and so we've worked together ever since I was about 5 years old.
Yeah.
So that really we've always been working hand in hand, so we've never really had any conflicts. And I've not been fired yet, so I must be doing something
That's
decent
awesome.
enough.
I love it. Yeah. Well, guys, I wanted to ask a few questions, but the first question I have is, what is something that you feel like people just commonly misunderstand about financial advisors in general?
I think just looking back over the years, one thing that's most commonly overlooked is that most people can do it themselves. While we love to manage money for folks, and we manage money for a lot of people, one thing that we've done over the years is help people do it themselves. And it's with a little direction and a little help, especially with today's technology. It's changed over the years and over the decades, but it's gotten so much easier with all the tools online.
Yeah.
The retail brokerages, Fidelity, Schwab, Vanguard, all these different companies. You can now, Robinhood is one we were just talking about earlier this week. And so that's probably the most overlooked thing I see, is that it's so easy to get started.
Yeah.
It's so easy to get started, and you don't have to have a lot of money to get started. You can get started with just a line item in your budget every month and start saving for retirement. Yeah,
that's true. I think some people do think that they have to have like X amount of thousands of dollars to even get started, and that's definitely not the case.
No, it's not. Now, if you go back and look, when you do the math, your contributions to your retirement are typically the largest part of your retirement, right? Mm-hmm. Growth on that is typically the second largest component or contributor.
Yeah.
And so it is important. But the sooner you start, the younger you are, you've got time on your side.
Yeah, sure. John, do you have anything to add to that?
Yes, I was going to add also just one other misconception is if you are looking at getting an advisor, there's a different way that some advisors approach fees. And what we do is we're fee only, and so there's just a flat fee for your assets under management with us. And there are other people out there, such as brokerage firms, and they do commission-based products. And that's something where they're regulated by FINRA, and we're regulated by the Securities and Exchange Commission. And essentially, we are fiduciaries, which means that we are legally required to act in the client's best interests. Commission brokers, they do not have that. They can sell products and such as annuities or just stocks or whatnot and just make a commission off of that. And that might be something to where there's a conflict of interest where if they're selling a product that has about the same amount of returns to the client, but they get a little bit more of a kickback, they'll be more likely to push that product probably than the other one, and the client has to end up paying that extra commission.
Ooh, interesting.
So that's something, and there's also duly licensed brokers, and that means that they can be fiduciaries or the brokerage, and that kind of also that makes a hand-in-hand conflict of interest also come to the picture. There's something we always act our best to eliminate any conflict of interest, but that's something to look for just because if you don't know anything about financial advisors or wealth managers, you just go into it thinking that everyone, Merrill Lynch or Charles Schwab or Woodard and Company or any of the ones in the area, they're all the same thing. You just give them your money and they manage it for you, but that's not always the case.
That's a great point. We play on the same field, but really we're apples and oranges compared to the broker-dealer world. And really it boils down to fees. What are you paying for your money to be invested? And so we try to, like John said, eliminate the conflict of interest.
Yeah.
And if it is in the case of somebody that we're managing money for, give them a pretty simple fee structure, easy to understand. And then if it's somebody we're helping and they're doing it themselves, then, get the lowest way to invest you can. That's more money working for you.
Yeah. Exactly.
If you can get your fees down. I mean, it's not free, right? Hiring us is not free.
Well,
but
nothing is free.
Nothing's free. There's no free ride. But if you can manage those fees, that's more money working for you.
Yeah, that makes sense. So what do you think, kind of piggybacking off of that question, what do you see a common money mistake that people make in their 30s or even 40s? I'm sure there's a lot, but back to what we were talking about on the front end, one of the most common mistakes is not having a budget. And in that budget, not having some sort of line item to save or to pay yourself. Yeah.
So, for example, if you live by the old rule of 80-10-10, right? Live off of 80% of your take-home pay. In our house, we tithe 10, and then we save 10. And so that but if you can have some structure where you're saving for yourself, that's the biggest thing. And if you can't do 80-10-10, do 95-5.
Yeah. Yeah.
Live off of 90%, save 5, give 5, however that works for you, and you're putting something away. Most companies now have a retirement plan, and that's something we really see not being utilized, although it's getting easier now because the rules have changed, and so a lot of people are automatically enrolled.
Yeah. Well, and a lot of companies will match.
Companies will match.
Yeah.
That's a key mistake right there, is not participating in your plan at least enough to get the match.
Yeah.
Because if you don't do that, you're leaving money on the table.
Yeah.
Right. So at least if you're participating in a retirement plan, find out what the match is, and at least try to contribute up to that. And if you can't do it all, let's say the match is 5%, right, dollar for dollar, and maybe you can only right now afford to do 3%. Well, next year if you get a raise, bump it up 1% to 4%, and then next year bump it up 1% to 5%. A couple of years you can be there.
Yeah.
But taking advantage of the little things, the little opportunities you have to save, and a lot of people have a bad thought or a bad idea for budgets. Like that's a bad thing.
Well, I think everybody needs a budget.
Everybody needs a budget, and a budget is just a roadmap for how you're going to spend your money,
Because if you don't, I've heard somebody speak about a budget recently, like you do like a diet. Like if you have no idea where your money's going or what you're eating, you're not tracking what you eat, it's not going to really work for you too good.
It's funny that you mentioned that because when we do, we meet with clients and folks, different folks, and from time to time somebody's in a bind, right, financially, and so we're trying to help them work through it with some financial planning. John's working on his CFP. I'm a CFP. Matt Blades in our office is also CFP. One of the things that we see if talking about budgets, spending on eating out.
Ooh, yeah.
You can really run up a bill fast. I mean, it's nothing to see $400, $500, $600 a month on eating out.
Oh yeah.
And not that you got to eat, right? But is there a more budget friendly way to do that?
Yeah, that's so true. And I know some people, myself included, if I'm not watching what I'm spending, I'm kind of guilty of like the end of the month coming and I'm like, well, where did all my money go? And I'm like, oh, it went to all of these restaurants and going, because eating at home is so much cheaper. But having a game plan, I think, is huge. My husband and I are working on that really hard this past year and this year, and are eating at home so much more. And it's like amazing the difference that it makes.
Oh yeah. And then when you do go out to eat, it's nice, right?
Yeah, because if it's an everyday thing, it's not a treat. It's
true. That's true.
It's also typically healthier too if you're eating.
Absolutely. Yeah, John, what do you think? What's a common money mistake you see with people?
I would say, especially for people my age, freshly coming out of college, is just not knowing the avenues of the different IRAs, traditional Roth, anything that you can be putting money away with. I think most people, they get out of college, it's their first time really getting paychecks, and so they just see that as their budget. They spend it, and they're not saving, or they're maybe putting a little bit away, but they're not thinking about the future. And I don't blame most of them because, I mean, in college, I didn't have any classes that talked about what to do with retirement plans or tax planning or any of that stuff. So I think that's something that's just not thought of. People think that once they start investing, in their 30s or 40s or 50s, then they'll be able to have money for retirement. But in actuality, the younger you start, the better it is.
Yeah.
Actually, Tony Robbins, great motivational speaker, he had a bunch of different finance guys come by his office, and they did a study. And basically, if you invest the same amount in money between 18 and 26 and just let that money sit and grow until you're 65, that would turn into more money than if you invested from 26 all the way to 65 and let that money grow. So it's just a compound interest.
Yeah.
Really adds up. And so that's just the younger you can, just even if, as Todd was saying, just anything you can in your paycheck, especially if corporations that you're working for has that 401k plan that'll match. But if not, Roth IRAs are always good ones because you put in money, after tax money, so everything that's in there when you pull it out, it's all yours, not Uncle Sam's.
Yeah, I hear you about the not having classes about that in school. I think that would be such a good move to have like a tax planning class that you take. Because I remember, I'll never forget being in my early 20s. It was like the first or second, maybe third year after I had graduated college, and I was self-employed, so I got like a $9,000 tax bill, and I boo-hooed. I'm like, what am I supposed to do?
How does this happen? Yeah,
because nobody really tells you about that. You have to figure it out the hard way.
Yeah, when you see those tax withholdings on your paycheck, that first paycheck, that's an eye opener.
Yeah.
But John makes a good point. The Roth IRA is due to income restrictions and things that you might encounter later on in life if you're making more income. When you're right out of college and early on, you're within the thresholds of contributing to a Roth IRA. They do cap it at certain income levels, depending on if you're married filing jointly or single filer. But it grows tax free forever.
Yeah.
Your earnings grow tax free. You put in after tax dollars in the Roth IRA, and then the earnings grow tax free forever, and you're not required to take a minimum distribution when you're retired. You can't take it out until you're 59 and a half.
Yeah.
So it's an and rule. It's got to be open for 5 years, and you have to be 59 and a half.
But you don't.
But that's long term,
taking,
right?
Yeah.
And you can always get to your contributions. You can always pull your contributions out without any penalty because those are after tax dollars.
Oh, I didn't know that.
So
I like to think
you would only want to do that if it was an
touch.
emergency, right?
Yeah.
I mean, like if you had an emergency or something,
Yes.
then and you exhausted your emergency fund or something like that.
Sure.
Then you say, well, I could get my contributions out of my Roth if I had to.
Yeah.
So you could do that. But it's a great point. And John, the nice thing about John being in the office now is he brings a youthful element to the office, and and whether it's these types of discussions or technology, I'm kind of a hybrid. I still write notes in cursive and type notes on the
Cursive? What's
computer.
that?
Yeah. But John's all the time looking for the how can we hone our technology and make it better.
Yeah.
Especially with AI coming around, just
Ooh,
trying
yep.
to see all the different tools that are around that we can utilize. It's quite fascinating what all is available and what can be done to just hone down your tasks in a given day and save time.
No doubt.
A little spooky sometimes too.
I agree. Yeah, AI does freak me out a little bit, but it's coming. It's here.
It's here. It's here.
So one more question before we talk about the market, which I want to hear about. I want each of you to answer this. What would a good day in your job and this work look like for you?
For me, a good day. Well, we always like green days on the market, right? We like it when
Sure.
the market's up. That's always a good day. And it's funny. I think, that's a good question. A good day for me is when a client understands how they're invested. Some people, they don't want to mess with it. And they just want to give it to you to manage and call me. Don't call me, I'll call you.
Yeah.
That's not everybody.
Yeah.
But that's actually more often than not. But one of the things I'm really passionate about is making sure that people understand their risk tolerance and their investment objectives, and are they allocated appropriately? Do they have the right combination of stocks and bonds? To handle the volatility that the stock market brings.
Yeah.
Can they sleep at night? These types of things. You don't want somebody worrying about their investments. They got to work. They got their job and their things that they do well. They got to worry about that. If we can take that load off their hands for investments and make sure they're allocated, that's our job. Make sure you're in the right. And that doesn't happen overnight. That might take a year. That might take 2 years sometimes to figure out with a new client.
Yeah.
You got to go through some market cycles sometimes to figure out. Oh, yeah, I don't like being this aggressive, or I could be a little more aggressive.
Everybody's different. For
so
sure.
that's something I've learned over the years. Just trying to make sure that the client is comfortable with where they're invested.
Yeah. What about you,
that's a good
John?
day.
What's a good day for you?
I don't think I can answer quite as well as Todd did there. But I don't do as much on the client side of things, but just anything that I know that is benefiting the clients, and I know I'm putting my efforts out there to make them, no matter how big or small the account size is, if it's a $10,000 account or a $200 million account. We don't have any accounts at $200 million, but it doesn't matter the range of the size, but just knowing that for big or small, helping those people out. And then also knowing that what we're doing is the right calls, trying to use our best judgment to predict what's going on in the markets and seeing those things play out as we expected them to, whether it's good or bad, but we knew it was going to be the good or bad. That really is a good day, just knowing that we made the best decision there and our clients are going to benefit from it. And typically that means also we get the benefit as well. So that's great. But just getting all those tasks done, it really helps me sleep at night. That's for sure.
There you go. John does a good job of keeping us out front too. Woodard and Company out in the community and making sure that people know where we are and who we are.
That's awesome.
And he does a really good job.
Thank you. Yes, we try. The marketing, every Wednesday marketing committee meetings, we have some wonderful people on there, great minds. And
yeah, well, because marketing has just evolved so much.
It's so different.
it has.
With being on social media and doing things like podcasts and being everywhere, but intentional.
Yeah.
Yeah.
Yeah, very much.
So let's talk about the market. What's happening? Tell it to me in the layman's terms, because
Layman terms, yeah.
I'm not.
You want to kick it
I
off,
can
John?
start off.
Yeah.
So things are hectic right now, just with geopolitical tensions. We have the Venezuela, we have Iran with all their protests and whatnot, is causing oil to go up and down. I think I'll just start off with the American economy right now. I think things have been in the proper direction. GDP numbers have been showing more resilience in the past few quarters, up more than analysts expected. One of the biggest drivers that pulls the markets is earnings growth, and S&P 500, the main market index for America, last year had about 14% earnings growth, something like that. And typically the average is about like 5 or 6%.
I was going to say, that seems really high.
Very, very high. And this year it's projected to be about the same, 14 or 15%, and that shows the resilience. But it is the fourth industrial revolution really that's coming through, which is AI. So I mean, we're still bullish on that end of just that's going to continue going on. The financial sector, they've been coming out with earnings here with like big banks like J.P. Morgan, Goldman Sachs, BlackRock, and they've been showing the consumers still showing their resilience in the markets. Of course, you have the talks of the K-shaped economy where the top 10 wealthiest are spending more than taking more of a share. I think it's like 50% of the goods purchased and goods and services are the top 10% of the wealthy, and that's increased from like 45% back in early 2000s. So you see some strength lightening out of that. So certain income levels might not be benefiting as well as others, but inflation is down from this. The Biden era in 2022, inflation reached 9%. Now the most recent reading was 2.7. It's still above the Fed's target, but that is something we're heading in the right direction. And tariffs, which everyone thought to be inflationary, there's many articles that have come out in the journal recently that show that actually they did studies going back from 1850 or so to 2022, and they've shown it to be mildly inflationary at most, and that's what we've kind of seen. So that's something that it's not really being too fully passed on to the consumer, because that's if inflation was way higher, it would be a lot more in the consumer's hands, and that's something that would be bad affecting just everyone. Just the prices of eggs were still sky high. I mean, definitely still rough going to the grocery store to buy a dozen eggs these days, but it's lower than what it was.
Sure.
8 months ago, 10 months ago, but overall, there's just so many different things going on with Fed Chair Powell, his term ending in May. There's a lot. Just Donald Trump keeps trying to get him kicked out. But just recently, earlier this morning, they came out saying that he does not plan to fire him. So we'll see about that. But
interest rates play a big part on that. Interest rates, if they can come down, they have come down, right, over the last year. So that, like John mentioned, the consumer's strong in America. The consumer's still strong. But if you can get interest rates to come down, that'll give a little bit of relief to the consumer. It'll give them a little more borrowing power. In particular, when it comes to new homes and things like that, housing values are still pretty high.
Yeah.
And so, but when you look at interest rates historically, these rates where we are fairly normal. When you look back just over the last 15 years, when we had quantitative easing, which held interest rates down abnormally low, well then these rates look high.
Yeah.
But when you go back to World War II, these are more normal rates.
Yeah, that's a good point.
So, our first house, my wife and I, Catherine, we bought our first house in 2000, and our mortgage was 8.75% on a 30-year loan, and we were happy to get it.
Wow.
Because it was under 9.
Yeah. Oh my gosh.
So we were tickled. But interest rates from that, even then, it was a steady decline. So the consumer's strong. Interest rates, appear to be coming down slowly, but they're coming down. And one thing to think about too, kind of bringing it all in. The market had a really good year last year. Had a really good year in 24, ended in 23. So we're coming off of 3 years of really good stock market performance.
So it ain't going to last forever.
Well, it won't, but what you need to know is a good point. What you need to know is, and this goes back to those things we were talking about early on in the podcast about how to save and the magic of compounding interest and all these things. if you go back over the last 120 years, the market the U.S. market, stock market, S&P 500, if you go back to the U.S. stock market, it has an average annual return of 10% over the last 100 years.
Wow.
9% over the last 200 years. Not guaranteed, but if you use that number, and so maybe you back it off a little bit, right? Like maybe 8%. If $50 a month at 8% for 40 years, you're going to have like $175,000.
Wow.
If that's all you did.
Wow.
If you did $100 a month at 8% over 40 years, you're going to have something like, I don't know, I think it's $375,000. But then you run that out, so you use the market, the leverage from the market, and stocks are the best hedge, one of the best hedges against inflation. So everything we do, this is a average conversation within our office when we're all standing around talking. These are the types of things we're talking about.
Yeah.
Because these are types of things that our clients are concerned with. So
sure.
But the economy's strong. It's really healthy. It's got its fits and starts for sure.
Yeah.
Markets, they'll pull back. We'll correct at some point. We'll get a 10% correction. We got a 20% correction last year, about 11 months ago. It wasn't a correction. Technically, that's a crash.
So
20% downturn in a short amount of time. Textbook is a crash. 10% correction is a run of the mill, and we'll probably get one sometime this year at least.
Yeah.
But those are great buying opportunities if you're in your 401k. You're buying it on sale.
Yeah.
So
Everybody likes a discount.
It's kind of like going shopping the day after Christmas.
Right. Black Friday sales. Yeah.
Yeah. Yeah.
Well, guys, this was so much fun to chat with y'all and learn a little bit about the financial world. I'm in the right career because math is over my head. But it was fun to talk with y'all.
No, this is great. Thank you for having us. We really appreciate it.
It's
Yeah.
wonderful. Pleasure to meet you.
Yeah.
Just have this talk. It's been
Yeah,
great.
awesome. Well, guys, if you enjoyed this episode or any of our episodes, we would love it if you would leave us a rating or a review. And as always, you can find Forsyth Mags online at forsythmags.com. And where can we find Woodard and Company? Do you have a website, social media, any of that?
Website at wcamg.com,
Okay.
or you can just call us at 336-998-7000.
Yeah.
Awesome.
We're over in Bermuda Run, just west of Clemens.
Awesome.
15 minutes from downtown.
Well, thanks, guys.
All right. Thank you.
Thank you.
And that's a wrap for today.
The views and opinions stated on this podcast are solely those of the contributors and not necessarily those of our distributors or hosting companies. This podcast is copyrighted and cannot be reproduced without expressed written consent of Forsyth Magazines Incorporated. Whew, that's a mouthful.